welcome to the post-trade part of the conference. Clearing and settlement still is about plumbing and vision, of course. But in addition to putting the pipes in place in an efficient manner, it has become increasingly important to understand exactly what's going through the pipes. And dependent on that information, to define the material and the dimensions of the pipe, as well as the connections between them. So in other words, risk management and the right structure for the markets have become key features of what we are doing. When we look at the European cash equities clearing space, the key theme over the last couple of years has been interoperability, where any given market is cleared by 2 or more CCPs, and these CCPs interoperate in processing the trades and managing the risk between them. And as opposed to the title here, which talks about imposed interoperability, at least for cash equities, that is a market-driven initiative. And in 2009, early 2010, both the trading venues and the CCPs were fairly advanced when it comes to interoperability. And then finally, the regulators in the UK, the Netherlands, and Switzerland stepped in and defined requirements for CCP interoperability. So basically what they said was any interoperability model must be scalable when it comes to the number of platforms it serves, but also to the number of CCPs. So the models we had in place until then, basically between LCH and ourselves for the Swiss and the London market, that was on a bilateral basis. New models must be able to serve 4, 5, or even more CCPs and various venues. Most importantly, the regulators concluded interoperability means additional risk that has to be covered by additional collateral. They don't really care about where this additional collateral comes from. It could come from the members and could be reused in that sense. But what they do care about is it must be additional and it must be independent of collateral that has been collected for margin purpose already. And finally, well, the model must be transparent. Key contractual elements must be published, but that clearly is less of an issue. So where are we today? In May this year, the interoperability framework proposed by the CCPs was approved by the regulators in the UK and Switzerland. As a consequence of that, EuroCCP, LCH, and 6xClear are now interoperable. They have the respective legal contracts in place. They have the procedures in place. They have implemented different models to address the inter-CCP risk and to collect the respective additional collateral needed for that. And this model has been implemented for both the London Stock Exchange and the Swiss Exchange, which have been interoperable since 2008 and 2003, respectively. And we have seen the first 2 venues with UBS MTF and BATS having implemented interoperability end of July this year. Now, in the meantime, major trading venues have announced concrete plans for CCP interoperability to be implemented over the next couple of months. Turquoise will be the next one to follow in November this year. We have Chi-X early January. That will also be the point in time when BATS will switch from the preferred CCP model they currently have in place to full interoperability. And most recently, Nasdaq OMX has announced interoperable clearing for end of April next year. That, of course, also means that additional CCPs that are either incumbent CCPs or have been mandated to clear these markets must become part of the interoperability framework, so mainly EMCF. And that is work in progress, that is well advanced, at least from our perspective, and we all expect it to be in place early next year. Now, what does that mean for the European cash market come mid-2012? From my perspective, we'll see a market that is divided in 2 parts. On the left-hand side, you have the pan-European venues, mainly the MTFs, and a couple of exchanges that are embracing interoperability. For the MTFs, interoperable clearing has become a competitive factor, and there is evidence that by bringing in additional CCPs, that will give you access to the local broker communities of those CCPs, and that is an element for growth. So what we're going to see, I guess, on the back of BATS, Chi-X, and Turquoise as the main pan-European markets becoming interoperable, the smaller MTFs will follow suit. And in that space, we're going to see a level playing field for the 4 competing CCPs. And this slide is 2 weeks old, so in the meantime, I think it has been more or less announced that EMCF will have access to Turquoise as well. So it will be a true level playing field where all 4 competing CCPs will have access to the pan-European MTFs. When it comes to regulated exchanges, that's slightly different. Historically, both the UK and Switzerland have been interoperable. Nasdaq OMX has been committed to interoperability for a couple of years, and now it's becoming concrete. But there we're going to see, at least in the medium term, we're going to see differences when it comes to access to these markets. Requests for access to the trade feeds are outstanding, but ultimately it's up to the exchanges to make the decision which CCPs should clear the flow and which not. What we also see is that the LSE group is introducing CC&G as a 5th interoperable and competing CCP. The first venue will be Turquoise. So that is the left-hand side. That in terms of clearing volume, not in terms of turnover. In terms of clearing volume, that represents roughly 60% of the European on-exchange cash equities clearing. And there will be fully fledged competition between 4 or 5 CCPs. Now, when you look at the right-hand side, those are the markets that are structured and will continue to be structured according to domestic value chains. And whether those are vertically integrated structures or not, there basically is very little incentive for the market infrastructures to open up, at least commercial incentive to open up. And I guess it will depend on a combination of regulatory pressure and potentially, in some cases, remedies in the context of mergers to change the market structures and to ensure that access to the trade feeds of those stock exchanges will be open to other CCPs as well. Now, one of the questions is, with this fragmented structure for Europe, does interoperability make sense, and are there any benefits to gain? And the answer clearly is yes. 60% is a significant share of the market. The market is behind interoperability. As I said before, it's not imposed, it's a market-driven initiative. And on the examples we are seeing, well, traditionally on the Swiss exchange and the London Stock Exchange, there have been migrations. LCH has roughly 30% share on the Swiss exchange. We have roughly 20% share on the LSE. With BATS preferred clearing, we have seen announcements of firms that have switched their CCP as a consequence of interoperability. So there are clearly benefits. First of all, market participants have choice. They can consolidate across multiple venues in their CCP, in their preferred CCP, and they can do that at the marginal rate. Secondly, competition will result in ongoing price competition and innovation. We can see reduced collateral requirements due to margining across all the venues. We can see consolidation of default funds and other collateral synergies. There is netting, settlement netting across the venues wherever it's supported by the market practices. And finally, as I mentioned before, it has become a competitive factor for the trading venues and is seen as a growth driver for them. Just to give you a tiny case study from our perspective, we have been interoperable since the very beginning in 2003. And when you look at the development of volumes and prices over that period, volumes have grown by 800%, while prices have come down by 90% over that period. And I think that is a pretty clear message to the market that interoperability and competition does deliver benefits. Now, in this new world of choice, what are the buying criteria for market participants? Most importantly, market players want their provider to be in the place in the long term. Sustainability is key, and that includes the sustainability of the business model, the sustainability of the financials, and also a viable fee model. But on the other hand, I think we have to be fair, the service is increasingly commoditized, and end-to-end costs are a key decision criteria. And end-to-end cost doesn't only include clearing fees, which are often highlighted, but also settlement fees and settlement efficiency in that context, and of course also cost of collateral. And what we have seen in the light of interoperability is that basically all 4 competing CCPs have announced another round of fee cuts, and now we are seeing the fees converging at a very low fee level, basically far below of what has been charged a couple of years ago. Venue coverage, at least in the medium term, will be a buying criteria. As I said before, there's a pretty level playing field when it comes to the pan-European MTFs, but differences will remain for domestic stock exchanges that support interoperability. Risk management is increasingly important, with CCPs being considered systemically important players going forward. So the overall risk model is a decision criteria, the structure of the default funds, as well as the approach to inter-CCP collateral. And there we see different approaches. For example, we contribute part of that collateral requirements ourselves, while others collect 100% from their clients. There still is little room for differentiation when it comes to functionality, typically in reporting, in-strange net settlement, and for some market players, governance and ownership is a decision criteria as well. I think that is of decreasing importance in a competitive world, because the strongest signal you can send as a market player is to move your flow at any time. Now, with interoperability happening, what are the next steps for the European clearing industry? Well, the first question is, what's going to happen to the other 40% where we don't see any concrete plans for interoperability? Will EMIR or potentially MiFID II or a combination of both enforce a wider scale interoperability across all European markets? Still to be seen. I think the code of conduct, at least in that regard, has been successfully ignored by a couple of markets. MiFID has been successfully ignored by a few markets so far. So to be seen what can be achieved by EMIR and MiFID II. The second question is, clearly the clearing space is too fragmented. Interoperability is a means to an end, and the end is consolidation. So how will the structure look like after interoperability? Is there enough space? When we look at the 60% that will be contested going forward, the overall size of the pie is going to shrink. There will be consolidation at very low marginal rates. So who can survive? Who can't? One of these CCPs is in the process of being sold. And to be seen what the next steps are. Next question is, we are talking about cash equities here. So is interoperability also a recipe for other asset classes where we see fragmentation? For example, OTC derivatives, where I believe nowadays there are 13 or 14 or 15 CCPs on both sides of the Atlantic. To be fair, only very few of them have critical mass. But there clearly is fragmentation. So is interoperability the right approach for that asset class as well? And finally, when we look at competition, it has started on the clearing layer with MiFID in 2007. Now it has cascaded down to the clearing layer with interoperability. So what is necessary to introduce competition on the settlement layer? Can T2S be a catalyst? Can link up markets help? I think that is food for thought beyond interoperability. Thank you.
Thank you, Tomas.